are my key takeaways from NMHC 2023, the conference where all the big boys in multifamily come out to play? Number one, there is a lot of distress in the highly levered, floating rate, low cap rate deal world. But there's a lot of rescue capital out there in the form of mezzanine financing or preferred equity. Now, if sponsors go down this route, the thing is it buys them time, but it comes potentially at the expense of wiping most, if not all, of the existing LP equity. Number two, everybody's a buyer, nobody's a seller. If I did a shot for every time I heard the phrase wide bid-ask spread, I would be dead. A lot of owners don't want to sell at a loss. And my gut tells me with the amount of rescue capital out there, pricing isn't going to fall for as much as we think it's going to fall. And lastly, sponsors are going towards fixed rate debt, but not for the reasons you think. Look, bridge debt is very expensive, 8 to 9%, but sponsors still want to use floating rate debt for the flexibility it offers. The only issue now is with bridge out of the market, it only leaves two major lending options: agencies or bank financing. Bank financing is recourse and typically has execution risk, whereas agency financing doesn't have execution risk and is a preferred lending option. The only issue is agency lenders are escrowing sky-high amounts every month for interest rate caps, which is basically killing the cash flows in the deal. So now a lot of sponsors are looking at, say, getting maybe a 5-year fixed rate agency debt with a step-down prepay. This conserves some of the cash flow in the deal, but it also allows them operational flexibility if they want to exit, say, in years 3, 4, or 5.